Welcome back, dear students. In this presentation, we're going to continue our long march regarding stocks with common stock characteristics. My favorite characteristic included dividends. And then we'll just begin to tackle this most watched common stock characteristic, and that's price to earnings ratio. But before we do that, let's get started on slide 60 with a spin-off, stock spin-off. This is a conversion of one of a firm's subsidiaries to a standalone company by distribution of stock in that new company to existing shareholders. In other words, they're spinning a piece of themselves off. They're breaking a piece of the company off and sending it off on its own. Sometimes the new company is still majority owned by the company that spun it off. For example, Kraft Foods was spun off by Altria, the old Philip Morris cigarette company. Then Altria divested itself of the international tobacco business. At one time, Altria, Philip Morris, owned Post Cereal and Miller Brewing and all these companies, and they've spun them all off. Then Kraft got together with Heinz, right? And they spun off, before they did that, they spun off the part of the company that makes Oreos, Mondelez. Oh, it's crazy. The history of spin-offs has been checkered. Some spin-offs have done better than the companies that spun them off. Examples of this are the Baby Bells, after being spun off from the old AT&T. Now, many of you were nowhere near even alive yet, but in 1984, the phone company was one huge company. There were a couple of other players, but no, the entire country was under the monopoly of Ma Bell. And the government said, it's time for you guys to break up. Okay, so finally they did it. They broke up into 9 regional bells called the Baby Bell, and then AT&T, which still owned the long distance company and Western Electric and Bell Labs. Well, they eventually sold off Bell Labs and Western Electric. That became Lucent, and we'll discuss them later on. But then the Baby Bells started merging with one another, and they got so big. Now there's only 2. There's Verizon, which used to be Bell Atlantic, and then there's SBC Communications, which turned around and bought the old AT&T, because that had fallen on hard times because of long distance just wasn't profitable as it used to be, and they took the name AT&T. They bought them. I think it was $16 billion, and I think they just wanted the name. Some spin-offs have not fared so well. Coca-Cola Enterprises was spun off from Coca-Cola. Coca-Cola makes the syrup, which is turned into this drink. Coca-Cola Enterprises was the company that bottled the Coca-Cola, and the idea was Coca-Cola Enterprises could compete and bottle other things, and they just didn't turn out so well. And then Lucent Technologies, as we said, they were the part of AT&T that made the equipment, Western Electric and the Bell Labs, the people who created the transistor, folks, and Unix. And Lucent Technologies didn't do too well, and then we'll discuss them later on. They were a major disappointment. Not because they don't build the best telephone equipment in the world, they do, but because they made some boneheaded business decisions back during the internet bubble. Slide 61, a stock split. Now, people get excited about stock splits, but really, folks, they're nothing. Well, there's something behind them, but anymore, they're really not that important. I mean, this isn't a maneuver in which the company increases the number of shares outstanding by exchanging a specified number of shares of stock for each outstanding split. And the most popular is a 2-for-1 split. So if you had 100 shares, you now have 200 shares. Yippee! Big deal. The price dropped in half. The price went from $20 down to $10. See, it's an accounting maneuver. There are 5-for-1 splits, there are 3-for-2 splits, there are reverse splits. This happens when a company's stock becomes so low that it's starting to touch the penny stock world. So the company is a real company, but they're just hit on hard times. They don't want to be associated with penny stocks, and also they'll get kicked off the NASDAQ or the New York Stock Exchange if they don't raise their price. So they'll do a 1-for-10 split. So maybe it was 50 cents, and they took away 10 shares, gave you 1 share, but now that share is at $5. So it's an accounting maneuver. There's no increased value from stock splits. Let's read together. If you had 1 share at 20, now you have 2 shares at 10. The value is still $20. Now, it's a psychological increase at best. But as we talked about when we talked about transactions, it made sense to split shares of stock because of the way stocks were traded, because they wanted you to trade in 100-share increments. But that's gone. That's not important anymore. And even at that time, before the Infernal Net, Warren Buffett of Berkshire Hathaway never liked stock splits. He always thought it was a gimmick. So he refused to split his stock since its inception. A single share now goes for around $689,000 as of September 2024. Wow. Well, folks, this is what would have happened to Coca-Cola or McDonald's or GE or some of these companies that have been around for 100 years. If they never split their stock, 1 share would be going for several $100,000. And what I see now is a company will split its stock when they want to tell the world that they're actually optimistic about what's going on for the company, but without actually telling the world we're actually optimistic about what's going on with the company, because they might get sued if it doesn't turn out the way they think it's going to turn out. So they split the stock as a way of saying, we're actually kind of excited about what's the future, but we're not going to tell you that. The treasury stock are the shares of stock that have been sold and then subsequently repurchased by the issuing firm. The company issues stock, and people then start trading it, and people want to own the company, people who no longer want to own the company. But if the company buys the shares, boom, those shares are taken off the market and put in the treasury. So you won't hear them say treasury stock. You hear them say stock buyback or share buyback or share repurchase. And this reduces the number of outstanding shares. So here's the logic behind this. The logic being that after the buyback, there is less supply of outstanding stock, fewer shares. So now existing shareholders now have a larger percentage ownership of the corporation. You see what's going on? There are now fewer shares, so your share is more of a percentage. Now again, a tiny little percentage, but it's more of a percentage of the total amount of the company. During the 1990s, share buybacks were often seen as a better alternative to dividend increases. The belief was that investors were more interested in capital gains than dividends, and that buybacks increased the potential for capital gains by reducing the supply of stock. Now, in the Tax Cut Act of 2017, the Republicans lowered the tax rate for corporations by, from 36 down to 21%. And it was a huge windfall. And the idea that the ballyhoo was that the companies were going to reinvest the money in new technological advances, and they were going to share it with the employees. And no, they turned around and bought back their stock and increased the dividends. I think AT&T gave every employee a $1,000 bonus. Whoopee. So that's the share buyback. Watch for that. Now, companies will have various classes of common stock. And those of you who did the bonus assignment for Chapter 2, where you found the top 10, actually 11, companies in the Standard & Poor's 500, you found that there's actually 2 classifications of Google. There's not just one. And the same thing is true for Facebook. At one time, GM, General Motors, they had, I think, 7. They had class A, B, C, D, all the way up to H, I think. I don't remember exactly, but now they don't have it anymore. And remember that Berkshire Hathaway, the class A are selling at this time about $689,000. And during the 1990s, the Wall Street folks on Wall Street were getting kind of angry at Mr. Buffett, saying, "Come on, you gotta do something. You gotta split your stock." "No, I'm not splitting my stock." "Okay, how about coming out with another share class?" He said, oh, all right. So in 1996, they offered a lower cost version of the stock for $1,160. So, he always gets the last laugh. And in the prospectus, I like this part. He said, don't buy them. No, you want to buy our stock, buy the A shares. If you can't afford the A shares, don't buy them. You stay away. Well, what's happened is that companies now will buy, several A shares, and then they'll break them up into tiny little pieces. So with $100, you can buy 0.0024%, 0.0024% of a single share of Berkshire Hathaway. And of course, many of the brokerages are doing this now. I still haven't gotten a good answer. I got to bug them. I called up Schwab a year ago, and they said, "Yeah, we'll get back to you on that." They never did. How much are they charging you for that? Obviously, our commissions are free. No. I want to know what kind of kickback they're taking when they. In other words, what's the markup and markdown when you buy and sell? And if you still believe that you're not paying any commissions when you when you buy and sell shares at Robinhood, go back to the third lecture. Yes, go back to the third lecture and listen to it carefully. So what happened after the B shares started to rise? In 2010, Buffett realized that he could use these shares kind of like cash to buy other companies. So he split them 50-for-1. And since they've now risen, I think they went down to like, $20 a share or something like that. And now they've risen to $459. So you can buy Berk A or Berk B. But be careful, because sometimes one share class has a whole lot more power than the other share class. This is Facebook. Facebook. Zuckerberg created a second share class that has all the voting rights that he's in charge of. So, and people are not too happy about this. So you can type in, different classes of Facebook. Well, actually now it's called Meta. And you'll see that some people are very angry at the way Facebook has done this. So check it out for those of you who are interested. 64. Now, you will see a few different values attached to a stock. One of them is the par value. This is meaningless, folks. I don't even know why they have it. I don't know the history. I don't really care to. I guess I could research it. But it'll say that this par value is 1 penny or 0.01 pennies. And I don't know why they do it. But if you can figure it out, explain it to me. I'd love to know. I think it's actually quite meaningless. The book value is very meaningful, especially if you're into accounting, because that's the net worth of a company. You take the shareholders' equity. You take the assets of the company, you subtract the company's liabilities and any preferred stock, which we'll talk about them. They're a little odd later on. And you get the net worth, the shareholders' equities. Now, they use the term book value, and there's a reason why. Because that's what they say the company is worth on the books. But that doesn't necessarily mean that those assets that they hold are worth that much. They might be worth more. They might be worth less. And the debts, though, are usually pretty straightforward. We owe this much money. But those assets may be worth what the accountants say they're worth, and they may not be. And there's a little accounting technique that some of you might be familiar with called depreciation. And we'll discuss depreciation later on. So the assets might actually be worth more than what they are worth on the books. But most people don't really look at this. We'll look at it later on. It's important, if only to see what's going on with the company and to see if they're failing, because sometimes the market value, the price, can go below the book value, and that's very dangerous. But it happens very rarely. So what's the one that everyone looks at? The price, the market value. This is the prevailing market value of a security that is set by the forces of supply and demand. What are people willing to sell their shares for? What are people willing to buy shares for? And we'll discuss valuation in detail in Chapter 4. Now, my favorite stock market statistic is dividends. Dividends are distributions of earnings given to stockholders, normally paid quarterly. Now, in the United States and most all countries that had something to do with the Great Britain, England, sometime in the past, like Canada and South Africa, Australia, Hong Kong, they typically pay quarterly. Outside those countries, and Great Britain itself, England itself, they typically pay semi-annually or annually. A lot of companies just pay their dividends once a year. But in the United States and countries that were associated with Great Britain at one time or another in their past tend to pay quarterly. The board of directors decides how much, if any, dividends should be paid and when to pay them. And we usually look at them as a percentage of the earnings per share, which is a very important number. The earnings per share is the amount of annual earnings available to common stockholders as stated on a per share basis. So if we own one share and the earnings per share is 50 cents or 75 cents, we could think of our one share of the company as a little business unto itself. And that earned 50 cents last year. And then they paid us 25 cents or whatever the dividends happened to be, or maybe they didn't pay us anything. And so let's take a look at some of the calculations here. Slide 66. Earnings per share. The company reports a net profit of $1 million. Well, that's a lot of money, but we don't really know what it means until we know how many shares are outstanding. So let's say there are 500,000 shares outstanding. So you take $1 million worth of earnings, divided by the 500,000 shares, and you get a $2 earnings per share. Now, do you have to do this calculation? No, you just look it up on the internet. We'll do a couple, just so we have a worksheet, and then we have a couple on the exam. They're very straightforward. The board of directors might decide, you know what? Let's pay out 50% of the earnings per share in the form of dividends. So 50% of $2 is $1. So that's called the dividend payout ratio. The company is paying out 50% of their earnings to shareholders in the form of dividends. Now, older companies, more established companies will pay out more than 50%. Companies that are just getting started, needing to reinvest that money, might pay out a little bit, a de minimis, a small amount of dividends, or they might pay nothing. They want to take those earnings and reinvest them back in the company. So the dividend yield on slide 67 then is a measure that relates the dividends to the share price and puts stock dividends on a relative percentage basis rather than an absolute dollar basis. So yeah, we're getting $1. How much did we have to pay to get that dollar? If the stock in the previous slide that was paying $1 dividend we're selling for $20, the dividend yield would be 5%. $1 dividend divided by $20 stock price gives us 0.05 or 5%. This makes it easier to compare stocks with other income-oriented vehicles such as bonds or savings accounts. Now, what's the difference? Well, sure. The bond, the interest that they pay you is mandatory. They promise to pay you that they usually pay every 6 months, but some pay every month. If they don't, they're going to get hauled off the bankruptcy court. The savings account is a bank. They're going to pay you, and if they go under, the Federal Deposit Insurance Corporation is going to come in and save the day and pay you back your money. But does the company have to pay you the dividend? No. Next quarter, they can say, nope, we're not paying this month. We're not paying this quarter. Now, some companies have been paying dividends for over 100 years. Some companies haven't paid any dividends. What I'm looking for, this is me, and this is one type of strategy. I'm looking for companies that are growing their dividends. Oh, I love companies growing their dividends. But that's, other people are like, no, I want to see the earnings. I don't care about dividends. I want capital gains. So that's why there's chocolate and vanilla, and some people like strawberry. Traditionally, 3 to 6% was normal. In the 1990s and 1980s and the 1990s, dividends went down to 2% or less. And we saw that at the peak of the market in March of 2000, it went down to 1%. Now, it's never been down that low again yet, but it's still pretty low. Dividends went above 3% in 2008 and 2009 when the price of the stocks fell. You see, if the price goes down, the quotient will go up. Figure that one out, you math fans. And they're now down back below 2%. I think they're actually 1.5% or something like that. They were a little over 1.5% a little while ago, but now stock prices have gone up in 2024. So now let's take a look at some important dates on slide 68. The declaration date. This is the date that the board of directors declares a dividend. And they say, we're going to pay you $1. And you have to be a registered shareholder on the date of record, the record date, or record date, or date of record. But it's a little trickier than that, because stock transactions, they clear in one day. You have to buy the stock before the ex-dividend date, which is one business day before the date of record. Huh? Well, hang on a minute. We'll discuss it in the next slide. This determines whether you are an official shareholder of a firm and thus eligible to receive the declared dividend. And then the payment date, the distribution date, is usually a few weeks afterwards. And they used to send you a check, but no, they don't send you a check anymore. It's all electronic. So what's going on here? Why do we have this date of record, record date, and ex-dividend date? Why is the ex-dividend date one day before the date of record? Because stock transactions close in one day. Now, they used to close in 2 days, and then 3 days, and 5 days. So it's been getting closer and closer and closer to, I don't think it's ever going to happen in one day. Mutual funds clear in one day. Bonds clear in one day. But stocks now have joined them, and now they clear in one day. So if you purchase the stock on June 16th, you don't actually get the stock until June 17th. So theoretically, the opening share price on the ex-dividend date should reflect a drop in price commensurate with the amount of the dividend. So, for example, if there's a $1 per share dividend, the opening stock price on the ex-dividend date should be reduced by $1 because they're taking $1 out of the company and sending it to all the shareholders. Oh, it doesn't work that way, right? Stock prices are going up all the time, or changing all the time, going up and down every day. But you must remember this. Now, most people, they don't care. It's, you're buying a few shares, big deal. But when the amounts become large, it's something to think about. And so you will hear on slide 70, don't buy the dividend. This is a common saying in the industry. You're often better off waiting until the ex-dividend date before buying the stock. The logic follows thusly. Dividends are taxable transactions. So if you buy the dividend, in other words, buy the stock before the ex-dividend date, you're responsible for paying the tax, and presumably the stock price will fall commensurate, fancy word, with the amount of the dividend. So you're better off waiting until after the ex-dividend date so that you don't get the stock. You will get the stock at a better price and not generate a taxable transaction. Well, for the vast majority of us, we're not buying 100,000 shares. But if you were making huge purchases, yeah, this makes somewhat sense. The same thing happens with mutual funds at the end of a year. At the end of the tax year, at the end of the calendar year, many mutual funds will declare their capital gains and dividends. So you may buy a large share. You might put $10,000 or $20,000 in. You get a bonus or whatever into the mutual fund, and then all of a sudden you get this $3,000 taxable transaction, the distribution of the capital gains or dividends, and you get a 1099. You have to pay taxes on that. So it makes sense in this case, if the numbers are large, to wait until after the dividends are paid, after the capital gains are declared. He wasn't my customer. He was my boss's customer. This is many years ago. Lots of years ago. And he was elderly, he was retired, he lived off his investments. He would deliberately buy the dividend. He would buy he did a lot of preferred stock, which often pay pretty healthy dividends. He would buy a lot. I mean, these were pretty big tickets as I remember. And he would get the dividend, and then he'd turn around and sell the stock. He just was interested in the dividend. He was living off the dividends. That was his strategy. I don't recommend it, but hey, it was his money. It was not my client, so I had nothing to do with it. But I was just very, very intrigued by how he was doing it. He was my boss's client. Slide number 71. So now, this is important, if only to warn you about stock dividends, which are basically useless. There are two major types of dividends. Cash dividends, which is what you want. Just remember, you want cash. Give me the cash. This is a payment of a dividend in the form of cash. This is the typical, what most reputable companies are going to do. They're going to pay you in cash. Now, some companies might say, oh, we're going to give you a stock dividend. This is payment of a dividend in the form of additional shares of stock. It's kind of like a stock split. All other things being equal, and of course they never are, stock dividends have no value because they constitute a dilution of ownership. So for example, the board of directors declare a 10% stock dividend. Yippee! For every 10 shares, you now receive an extra share. I got 11 shares now. Correspondingly, the price of the shares dropped 10%. Why? Because they've just diluted the company's value by 10%. So the price dropped 10%, kind of like a stock split. But unlike a cash dividend, a stock dividend is not taxed. Well, gee, IRS, thank you very much. You're not charging me something that's not worth anything. You're not taxing me on something that's not worth anything. Thank you very much, IRS. Yeah. So do you want stock dividends? No, you want cash dividends. Now here's where it gets a little weird. Slide 72. When you receive your cash dividends, you can tell your broker that you want a dividend reinvestment plan, a DRIP, which I love the name DRIP. Do you want DRIPs? Yes, you do. In fact, there's an example of a DRIP on the website in Canvas, so check it out. Through San Diego Gas and Electric, which is actually Sempra. Sempra Energy is the parent company. So the dividend reinvestment plan is a plan in which shareholders have cash dividends automatically reinvested into additional shares of the firm's common stock. Now, this is a taxable transaction, but they didn't issue any new shares. No, what they did, now they didn't do it. We had a dividend reinvestment plan through Sempra, through SDG&E. Sempra didn't do this. They hired some other company. I think it was called ComputerShare or EquiShare, some CompuShare. And what they do is they go out and buy the shares, and they take the cash from the dividends to buy the shares, and then they give you the dividends. Now, they're 0.3 shares or 0.4 shares. And at first, it's very little, but it's like a snowball. It starts adding up because the next time you're going to have more shares and the dividends are going to increase. Yeah, it's very cool. So there's no dilution of ownership, and DRIPs are an excellent way to own stock for those interested in long-term growth and not interested in the current income from the dividends. It allows the investor to take advantage of compounding automatically with normally no or very small transaction costs. Every once in a while, we get charged 3%, 3 cents. I'm not 3%, 3 cents, or 6 cents, or 9 cents. So check out the presentation on DRIPs. And now, most all brokerage firms will allow you to say when you talk to your broker or do it online, I want this to be a dividend reinvestment plan. Almost all brokers now do this. And it's very, very cool. In this way, your stocks become kind of like mutual funds, because that's what mutual funds do. Unless the default is we're going to reinvest the shares, we're going to reinvest the declarations of dividends or capital gains back into shares. So you could look at a company like General Electric, which is not as big as it used to be, or Johnson & Johnson, which is still pretty big, but they've spun off part of themselves, as a mutual fund, because they are taking the dividends and buying more shares of the company. Very cool. We like DRIPs. Slide number 73. Okay. We're almost done with this presentation because we're introducing the most widely watched market statistic, and that's PE, not physical education. Price to earnings ratio. You'll see it written as P/E or just PE. Very important statistic. It's actually very straightforward, but there's a whole lot packed underneath it, which we'll unpack as we go along over the next few weeks. It's the price of a stock divided by the earnings per share. So it's looking at the price of the stock versus the earnings that the stock is producing. And some people look at the other side. They look at the earnings divided by price. and that's something else. But we're going to follow the world and do P/E, price divided by earnings. So for example, if the stock we were looking at had $20 price, $2 of earnings per share, we would take $20 divided by $2, $20 price divided by $2 of earnings per share, and that gives us 10. Now don't put a dollar sign or a percent sign. You do, no one's going to mark you off for it, okay? But PE is unitless. So this stock would have a price to earnings ratio of 10. Now, traditionally stocks sold for 5 to 15, 12 to 15 was typical. Some stocks had much lower PEs, but if you had a PE of 20, well, that was a very fast-growing company. Well, during manias, PEs of 20, 30, 40, 50 or more are not unusual. During downturns, typically PE ratios come down greatly. We will spend a great deal of time learning PE and other valuation techniques in the next 2 chapters. Suffice to say, the higher the PE, the more investors are excited and enthused about the future prospects of the company. The lower the PE, the less enthused they are, the less excited. So you would expect companies that are growing fast to have high PEs. And in general, that is what you see. You would expect companies that are not growing very fast, like utility companies, to have lower PEs. And that is generally what you see, but not always. So we're going to see some examples as we continue our journey. I know this is a lot of information, folks, but think of how much you have learned. So go back over, listen to this again, watch it again, do the worksheet number 2. You've done the worksheet number 1, right, with the market indices? I hope so. Do worksheet number 2 and check out earnings per share, dividend yield, and price to earnings ratio. Because when we come back, folks, we're going to tackle different stock types. Very important. We're so proud of you. You are rising investment gurus, dear students. You are awesome. See you in our next presentation.